Hello, everyone. The U.S. economy just posted a negative GDP number, shrinking by negative 0.3% in the first quarter of 2025. At the same time, markets are now pricing in a 75% chance of a recession this year. A recession is commonly defined as 2 consecutive quarters of negative GDP growth. With the U.S. economy contracting by negative 0.3% in the first quarter of 2025, attention now turns to the second quarter. If we see another negative print, it would technically meet the criteria for a recession. The Fed is cornered, and investors are asking, is this the start of something bigger or just a temporary dip? Why did GDP fall, even though people and businesses are still spending? And what do gold imports have to do with any of this? Stay with me, because by the end of this video, you'll understand what the headlines won't tell you and what could be coming in Q2 and Q3. The U.S. economy shrank by 0.3% in the first quarter of 2025. That might sound bad at first, but it was actually much better than expected. The Atlanta Fed had predicted a drop of minus 2.7%, so this smaller dip is not a disaster after all. Let's quickly explain how GDP works, so the numbers make more sense. GDP, or Gross Domestic Product, measures the total value of everything produced and spent in the economy. It includes what people spend, which is also called consumer spending, what businesses invest, what the government spends, plus exports, minus imports. This last part, exports minus imports, is called net exports. If we export more than we import, it adds to GDP. But if we import more than we export, like what happened this quarter, it subtracts from GDP. Now let's look at what happened in Q1. Consumer spending added 1.21% to GDP. Even though it slowed a bit from last quarter, it was stronger than expected. Business investment added 1.34% to the economy, which is a big jump from last quarter when it was actually negative. One reason for this increase is that the government is now doing a better job counting how much money is being spent on building and upgrading data centers, the big tech facilities that power AI and cloud computing. Companies built up inventories, likely trying to get ahead of tariff hikes. That added 2.25% to GDP, though it's expected to reverse in coming months. Government spending dropped slightly, subtracting 0.25% from GDP. And the biggest drag came from net exports. Like I said earlier, if we export more than we import, it adds to GDP. But if we import more than we export, like what happened this quarter, it subtracts from GDP, which cut GDP by a massive minus 4.83%. That happened because the U.S. imported way more than it exported, especially gold, which was brought in early to avoid upcoming tariffs. Now let's talk about inflation and the GDP price index. The GDP price index shows how much prices went up across the whole economy, not just what people buy, but also what businesses and the government pay. In Q1, it rose by 3.7%, which was hotter than expected. Another key measure, core PCE inflation, which removes food and energy, came in at 3.5%, also above forecasts. That makes it harder for the Fed to cut interest rates anytime soon. Core PCE inflation removes food and energy prices because they're often highly volatile and influenced by temporary shocks like weather or oil supply disruptions. By stripping them out, they give a clearer view of the economy's underlying inflation trend. So what's the takeaway? Yes, GDP went slightly negative, but not because the economy is weak. Most of the drag came from temporary factors like a flood of gold imports and businesses stocking up ahead of tariffs. If those settle down, we could see a rebound in Q2 or Q3. This story isn't over. If you want to stay ahead of the curve, like and subscribe, because we're just getting started.